Before we start, I'd just like to say a quick thank you to our podcast sponsor, PensionBee, who are one of the UK's leading online pension providers. Now, PensionBee can help you transfer most of your old pensions together into one simple and low-cost plan, all through their app and online platform. Now, if you're looking for a low-cost, hassle-free way to consolidate your pension pots, except final salary pensions, that is, then PensionBee is worth considering, especially as it does not lock you in with exit penalties, which I really like. That's because it leaves you free to move your money at a future date if you so wish. I think it's a combination of investment fund performance, low costs, and its slick app interface, which has been integral in PensionBee gaining over 250,000 customers and receiving an excellent rating on Trustpilot from over 1,800 reviews. Now, you can sign up with the names of your old employers in 5 minutes. PensionBee's plans are managed by the likes of BlackRock, State Street Global Advisors, Legal & General or HSBC, and as always with investments, your capital is at risk. For more information, go to pensionbee.com.
Hello and welcome to episode 261 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leakes. Damien, how are we doing?
I'm good, Andy. You?
No virus just yet. I'm trying to keep the viruses at bay.
As we started this, Andy said to me, "You sound a little bit slightly deeper. Whenever you're ill, Damien, your peaks on the what do you call that thing that we look at while you're recording, Andy?
Don't call me out on that. I've got no idea.
The editing thing where you can see our voices.
No, it's a waveform.
It's a waveform. It's deeper if I'm getting ill. So Andy's now made me feel slightly alarmed, but I'm feeling okay. But yeah, it's been a good week. Lots going on in the investment markets. I'm going to talk about investment markets this week. In particular, what's been moving them, but trying to explain one or two moves. I've given away what's one of the pieces actually that we're going to do on the podcast, because I know there'll be lots of people who'll be panicking and looking at their portfolios. And in a time like this, when the markets are literally imploding as we speak, it can be a little bit disconcerting. And there are some strange moves. I hinted at some of them in midweek markets this week, but I just wanted to sort of spend a bit more time on it so people can understand why things are moving as they are. And when you understand something, naturally the fear starts to drop away, so you can actually work out why your portfolio has gone down. I know Andy was looking at his pension the other day and was like, no, my pension pot has dropped by X amount. And when you explain away that, you've actually done quite well in the scheme of things, then it makes people feel a little bit better. So I want to do that as one of the pieces. But before I tell you what's on the rest of the podcast, I have to mention somebody who won a mug or earned a mug. We didn't win it. They earned a mug this week, didn't they? Something mug-worthy.
That's right. Ben got in touch and the title of the email was, "Is this mug-worthy?" And absolutely it was. So anyone out there, it's still available. It's still open. If you've got something that you believe is mug-worthy, and by definition, it is anything. There is no definition.
There is. People have earned mugs for all sorts of reasons. And we had 2 more people sending their mug shots for the Mug Wall of Fame. So that was brilliant. If there's any of you out there who have mugs, who've not sent a picture, then please do so via email, damien@moneytothemasses.com or lauren@moneytothemasses.com, or you can do it via Messenger on Instagram, which can be easy for some people. So please do. But Andy, why did Ben win the mug? Earn the mug. I keep saying win, earn the mug.
He earned the mug. Well, firstly, I just want to say that in the first line of Ben's email, he said that he now has a pension and wills as a result of doing Damien's Money MOT. So that was fantastic news to read. If you haven't done the Money MOT already, we always link to it on the podcast notes, but go to mot.moneytothemasses.com and you'll be able to do that. It takes 2 minutes and you'll get your own action plan if you decide to sign up for that. But Ben got in touch regarding the piece we did on the podcast about Avios points and the American Express British Airways card. And there's actually a really clever way that you can get loads of bonus points without having to spend a huge load of money. Now, I wasn't aware, but you can actually buy Avios points from British Airways website. And Ben mentioned that if you want to do it that way, it's quite expensive. It works out almost £500 for 30,000 points. However, if you're a Tesco Club Card member, you can cash in those points on your club card and you can actually get the same amount of points for around about £125, which is a massive saving. So if you add that onto the points and the bonuses and then use those points to upgrade, you can get yourself a really good flight for next to nothing.
So if you combine all those ways that we've been talking about in recent podcasts, which started with a piece by Jordan, when Jordan had done a piece for us on Money to the Masses, you can save a lot of money on flights. Not that anybody's probably flying anywhere at the moment because of
Very
coronavirus,
true.
which is something I'll come on to later on. We did a piece last week, didn't we, on your rights? But this week it's got some interesting things you see happening in investment markets, in particular to the stock prices of those airlines, but I'll come on to that. Other pieces on this week's podcast: scams. Andy loves a scam. In fact, Andy, he wasn't almost scammed. He got nowhere near being scammed, but they did try and scam Andy this week. And interestingly, we were going to do this piece anyway on the podcast, and then the person tried to actually ring Andy up while we were talking and scam him, which is unbelievable. It just shows how prevalent it is. And the other piece is to do with buy now, pay later. We've never covered it on the podcast, but it's become such a popular way of effectively gaining credit that I felt we needed to touch upon it.
Great. What are we going to start with then this week?
Let's do the scam. Now, this started off via Twitter because those of you who've listened to the podcast regularly know I do different events every now and then. And it's Claire Barrett, who's the personal finance editor of the Financial Times. And she tweeted a story which, if you know the Financial Times, is behind a paywall, but they put one article in front of a paywall, which was about the HMRC scam that's been doing the rounds because they wanted to raise awareness about it. And I will put this in the Facebook group on the weekend. So when this podcast comes out, soon after, I'll put a link to the story on the Facebook group so you can read it and read the full transcript and what happened to the journalist in question. Because there was a journalist called Alice Cantor who works with Claire, and she was shocked when she got a phone call, supposedly from HMRC, claiming that she owed them tax. So the title of her piece was, "Would you fall for this £2,350 HMRC scam?" Now, this time of year, we get an increase in these scams that's supposed to be from HMRC regarding tax. And this one is particularly, I think it is convincing because they are persistent. So the article describes how the journalist in question was walking to work and received a phone call from a London 020 number. So not a mobile number, not a withheld number. And then when she answered the phone, because she obviously being in London thought maybe it was somebody she perhaps knew or it was relevant, there was a recorded message from HMRC saying there was a criminal court case being filed against her for not paying tax, as tax was due, and a possible warrant out for her arrest. Now, of course, that message would get most people thinking, what's going on here? Now, the recorded message then encourages people to click on click 1 to go through and speak to a representative, etc. about your case. So she did, and she went through and then proceeded to have a conversation with somebody that seemingly sounded like they were in a call centre, who had an answer for nearly every question that she threw at them about what was going on, and in the end holes in their story where she eventually worked out that this was a scam. But if you read the article, she was taken along by it for quite some time, as a lot of people would be, because they panicked into thinking they don't want to be arrested or have a fine. So what ends up happening, the tactics of this scam start getting quite heavy. So you end up getting to the point where you have two options, and you end up having to, you can either challenge it in court, they say, and face up to, say, 5 years in prison, or you can settle the fine now, or the bill now, and then you have to transfer them £2,350 in her example. And if you do that, then it's all okay and solved. Well, you can imagine there are a lot of people out there that have transferred the money faced with that threat. And if you go and find Claire Barrett's tweet, in fact, if you go to my profile on Twitter, Money to the Masses, and I tweeted a story earlier in the week, and you will go through to that link, you will find some people on there who actually say that they know somebody who's fallen foul of this scam and have lost money, £2,000 plus. So it's obviously convincing because the people are well practiced, well versed in conning people. But the best thing we can do is raise awareness about this sort of stuff and say to people, if you get anything from HMRC, if they phone you or text you, then you need to ignore it. And apparently in 2019, 900,000 people reported emails, texts or calls supposedly from HMRC as being false. It shows you how prevalent they are.
And they're just the people that are reporting it. And I'd say probably only 1 in 10 is reporting it. So that's a huge number.
It's a huge number, but they're not just about bogus bills or anything like that, or threats of arrest. They sometimes, the most prolific and most common scam starts out with 620,000 people apparently reported this scam, is where they're offered a tax rebate. So what better way to engage people than to say you're due a tax rebate? And what happens is they then direct you to go online to a fake site, and you end up providing bank details and personal information, which they then use to basically fleece you of your money.
So basically they're playing on two things here, aren't they? Fear and greed.
Fear and greed, the two biggest drivers of stock markets, actually, which is quite a nice segue into a later piece. But one of the strongest emotions. And this scam, as I said, we were in the office talking about, I can't remember what we were talking about, but we had been chatting about this particular scam. And Andy's phone rang. Yeah. And then we said, you might as well grab that, Andy.
And normally when a phone goes from an unknown number, I generally won't pick it up, especially if I'm at work. But it was an 020 number, and I thought, hey, it could be something to do with work. I was doing some articles. I'd made a few phone calls. I thought, yeah, I'm going to take this. And lo and behold, it was this recorded message, HMRC, which, again, from the number that was coming through on my phone, it looked very genuine. Now, luckily, we were talking about it already, and so I kind of knew what was going on and just hung up the call and didn't engage. But on a different day, maybe I would have done.
Yeah, and that's the reason why we're doing this piece, is because if we're getting these calls, I know there's a lot of you out there who'll be listening to this and said, yes, I had that call. So you need to tell people about it. Now, the general tips you need to remember and remind other people of is that HMRC will never contact you for bank detail information over the phone or anything like that. And they won't notify you of a rebate or anything like that by email or text. So if you get anything like this out of the blue, it's not how they will operate. They will write to you.
HMRC aren't that efficient.
They aren't. If you've ever tried to ring through, they really aren't that efficient. And so don't reply to any messages that you get or phone calls. Don't download any attachments. Don't click on any links, because that will normally take you through to something which is a fake site, a phishing scam with a PH, where they try and get you to input details which they can use to then either steal money from you or impersonate you. And if you're not sure if something is genuine, if you've had a phone call like that, if you've got self-assessment, then you could log into your self-assessment online and have a look to see if there's any issues there, or ultimately call HMRC. But make sure if you do, you go via the HMRC website to find the address, because there's another scam I'm going to come on to relating to a completely different company which has been doing the rounds on Google, which is going to catch a few people out.
If you're unsure, speak to if you're an employed person, speak to someone who runs your payroll, because they will be used to speaking to HMRC, and they'll have contact numbers. They'll also have the tax office numbers for your firm, and that's a really good way to make sure you're speaking to the right people.
And if you do get any of these approaches, then you can report them to HMRC at phishing with a PH at hmrc.gov.uk. And if you've been a victim of fraud, then you can report it to Action Fraud. Now, the other scam that's caught people out, again, people have lost about £2,500 to this particular scam, is one that's operating on Google, and it impacted Revolut, the tech startup that most people know, the travel cards that you use and prepaid cards, etc., when you go on holiday. Now, what happened in this case, the victim had Googled Revolut helplines. They were trying to get through to Revolut because they're having some issues, I think, with their app, and they were trying to load money or whatever onto their card. So they Googled it, and fraudsters had actually bought Google ads targeting the word Revolut helpline. So imagine that, what that looks like in Google. If you use Google, which we all do, it would mean the top results, which are usually 2 or 3 of them, are adverts. At the top there, it said Revolut helpline with a phone number underneath it, because when you buy Google ads, you can dictate what you want, not only in the header, but what appears below it. The victim then went through on that number, an 0800 number, ended up speaking to somebody particularly helpful, who then said he needed to take control of his phone in order to be able to make the app work. He used the guy's computer and webcam to help guide him while using the app. And then the supposed person at Revolut then passed him on to one of his colleagues, who then said to them, in order to test this, you need to now transfer the money across, etc. Obviously, it turned out this wasn't Revolut. The fraudsters are using Google ads to fool people into ringing numbers or going through to websites that are pretending to be Revolut. And you can see how it's an easy mistake to make. So the reason that links nicely to the HMRC scam, if you want to ring them and to check, you want to make sure the link that you're clicking on is genuinely the the website of the company, or HMRC in this case, the company in question, because otherwise you could end up finding you're just actually ringing a fraudster. And again, another bit of advice, when you end up having people ring you to say they're from your bank, there's nothing wrong with putting the phone down and then ringing back on the number that's, say, on the back of your card, rather than the number that they give you over the phone. It seems obvious when you say it, but in the moment when you're speaking to somebody and trying to solve a problem, or you've been, like you say, presented you with a problem or something like that, then it's easy just to not think straight and do something, because let's be honest, we're not all expecting to be scammed. So be careful out there. I think Google have got a lot of questions to be answered on this, because they allowed this scam to go through and Revolut customers to be impacted. It was only because it eventually reported that they found out about it. But if they're doing it with Revolut, they're likely to be doing it with lots of other people, including banks. So do be careful.
Okay, good. Moving on to the next piece, we're going to talk about investing portfolio moves. What have we got?
So on this piece, the aim of it is to try and help people understand what's going on with their portfolio. So let's say, for example, I go and look at my portfolio. So I do a portfolio of 80/20 investor where I invest £50,000 of my own money live. Actually, maybe next week I will do a piece on that, because the 5th anniversary of me running that portfolio was this week. And obviously I'm very, very pleased with the performance that's come out the other end, including this run with the coronavirus, because my portfolio has held up particularly well. In fact, I'll give you a snippet. I think there's only of all the equivalent funds in the whole sector, 225 funds in the mixed share sector, which has 40 to 85% equity exposure, those funds, my fund would be in the top 10%. So I'm obviously very pleased about that. So I will probably do more on that next week, just to let people to know how I did it, etc. But when I look at a portfolio, I therefore look at it maybe on a daily basis. I mean, I do only because I'm running the portfolio, seeing what's happening, but you shouldn't check your portfolios on a daily basis. But let's say you got to the end of the week or month and you looked at it and you're trying to understand what's happened to a particular fund. For me, if I see a fund was suddenly down, where some people might panic, I will try and work out why is that. I almost would try and second guess before I even look in the portfolio where I think a fund is going to be on a given period of time. So if I'm doing it today, for example, I'll look at what the market's doing and try and guess. And it's because there are certain narratives now that are coming through. We're in an environment where the coronavirus is leading the stock market. The fallout of the coronavirus is having such an impact that it's almost overriding a lot of other stuff that's going on out there. So we've all forgotten about the trade war, for example. Everyone's forgotten about Brexit. And the reason that is because the impact of the coronavirus on supply chains. So Apple mentioned it a few weeks ago. They're worried about the manufacture of their phones, being able to distribute them. That happens across the board. You think about exporters, importers, anybody. If you're building anything like a car, if there's a part that needs to be moving through a sort of a chain, a supply chain of some kind, then that ultimately means that the main product will be delayed. So that's an issue. You've also got an issue on demand side where people are being quarantined or people are not going out or buying less or whatever it is that's starting to impact the economy. And what's happened is the virus has caused people to realise how fragile the global economy already was. And in fact, the global economy was slowing. There were signs it had been slowing for quite some time, although nobody was really paying attention to it. And I've talked about it in midweek markets for obviously a number of months now. And I think the virus has just been almost the straw that's broken the camel's back. And so at the moment, the market is fearful of it and is panicked. We'll have to see what happens going forward. Central banks whack the panic buttons this week. But I want to give you an example. So if I looked at my portfolio now, and I might have a range of funds in there, and I would have, say, a fund that has UK equity exposure. Now, the UK equity market has fallen nearly 10% since its highs. In fact, I think today, with today's sell-off, it'll be down about, say, nearly 13-14% from its recent high. So it's a hefty fall. In an environment like that, pretty much everything's going to fall. In a market, if you look at it, the assets have become more correlated across the board, because that happens when markets really capitulate and panic. So you tend to get all assets start to tumble. In that example, you've got a UK equity fund. You're going to expect it to be down something, like I said, 10 to 14% anyway, because if it invests in UK equities in an environment like this, the manager is not going to be able to do too much to stop it. If you're invested in smaller companies, they might be even more volatile and people might get out of them and sell them because they're more panicked about the impact on the economy. And of course, don't forget, smaller companies have more exposure to the domestic economy. So as soon as there's bad news about the domestic economy, then their share price will start to fall. So you can expect the things that are high risk and volatile are going to really start to sell off or have sold off. Now, having said all that, if you look at the fund and you see a fund has fallen and you're wondering why it has, and say it's an equity fund, go and have a look at the fund fact sheet and go and have a look at which sectors it invests in. Because although a fund might be a UK equity fund, it might invest in particular sectors, have more skew one way. It might be more skewed towards banks, financials, or it could be industrials, it could be technology, it could be utilities. So each of those areas behaves slightly differently in an environment where everybody's scared about an economic slowdown. And what you'll find is funds that have a skew towards more defensive sectors, so utilities and REITs is one of them, real estate investment trusts, so property shares, have tended to do better. Doesn't mean they've not lost money. They have outperformed, because if you think about it, in this environment, when the economy is slowing and interest rates are being cut, so in a low interest rate environment, then what will happen is investors will gravitate towards good income producers, and they'll gravitate towards companies that have had a good history of maintaining their dividends. Because in an economic slump, and if we have a recession, then what will happen is that companies may be forced to start cutting their dividend payouts. So what you'd want to do as an investor, especially if you need the yield, the income, is you will start to move towards good income producing assets. And that will be property via real estate investment trust. That will be things like utilities. So you will notice that the things that start to rise to the top are funds that invest in things like infrastructure. And if you look underneath, you'll notice there'll be funds probably with the words infrastructure or something like that in their name. Not that a name you can judge a book by its cover, really, but if you dig beneath, you'll see particular sectors that are starting to perform well. Financials, on the other hand, are one where you'll see funds are struggling, because in a world of low interest rates, banks can't make as much profit on their loans, so therefore their profits are hit, so they are sold. And you'll see, if you look at these sectors, that they've sold off the most in this recent slump. Obviously, travel and leisure, so anything to do with airlines, has been hit. So if you have a fund that's exposed to things like travel, hotel companies, then that will be slumping. So you can have a look at your funds and understand why. Sometimes it is just because all boats are sinking at once. But if you have one that's doing far better, say it hasn't lost as much, or far worse, then dig beneath and you'll probably find out why that is. So that is always interesting. I look at those funds in my portfolio. I've got quite a bit of exposure in my equity component towards REITs and utilities. But then if you'd looked last week on the Friday, so a week or so ago, then defensive sectors actually underperformed quite a bit on the day. And they were down, say, 2%, whereas the things that had been selling off before were barely down or down 1%. So you're thinking, why was that happening? Over the length of the sell-off, they were still up on the other sectors, but they suddenly almost caught down a little bit. And that's a sign of like complete capitulation almost, where people are panicking. They sell stuff that is most liquid, but particularly because you get investors starting to need to raise capital. So they've got margin calls at the brokers, so they have to put up more collateral or whatever.
It's just like a fire sale. Get rid quick.
Yeah, we were talking in the office about it. So imagine if you couldn't pay your mortgage, for example, and you were worried about it and you're having to pay things you don't want to lose, so like your house. You will start selling stuff and you'll probably just grab the most easily liquidated or the most valuable thing you've got. So you don't really want to sell it, but you'll know you get the most money the quickest. So you'll grab your laptop and you might flog that for like a couple £100.
Xbox, TV, children, that kind of thing.
Yeah, it's basically what bailiffs do when they come in your house. They look at it and do the same thing, but in reverse, but to take it away from you. That concept can happen in a sell-off. So you get this initial sell-off of all the stuff that people don't want, really dips. And then the stuff that's been performing well then also has a bit of a dip. And it can be a sign that, are we nearing the bottom of the sell-off? I mean, if you look at today's market, well, I think we've broken down below the lows previously, which suggests we might have further to go down. But the other thing is that gold. Now, gold is the one asset that people always talk about when in fear. And Warren Buffett once famously said that people only buy gold. Well, basically, if you hold gold, you're hoping someone's going to be more fearful than you in the future and buy it off you from a higher price. But again, on that sort of Thursday, Friday, gold fell about 3.5-4% in the day, which you think it shouldn't happen when the market is completely capitulating and collapsing. But again, it's because people were selling gold to try and meet margin calls. And also, I think it was some emerging market economies selling gold because they were trying to defend their own currencies, something I won't go into. But you can see, you get these moves and you suddenly might have panicked on that day and gone, oh my God, what's happening? My portfolio is just imploding. I thought it was slightly defensive. But then come Monday, the normal trend resumed where everything else was falling and the defensive sectors held up better. So you're going to get these moves as you're watching it. Technology is an interesting one. Now, you might think that tech would sell off because it's been the biggest leader and it has had a big pullback Apple's had a big drop in its share price. I think it was almost heading towards bear market territory the last time I looked. But the funny thing is, tech in a low interest rate environment has an attraction because their earnings and the reward is way off in the future. Because don't forget, these tech companies are all about growth rather than necessarily producing an income and stuff like that for investors. The prize is a long way off. If interest rates are low, then when you discount that back, that prize at the end, then that's worth more. And that means that's basically a share price is a discount of the future almost income, the prize that they're being paid over time. So if interest rates are low, then it means their share price goes up. So funny enough, tech is quite an interesting one that does tend to get buoyed in if rates get cut. The other one is oil and gas companies suffered because if there's going to be a recession, then there's going to be less demand for oil and certain other commodities, copper in the world. You see their prices fall, and so therefore oil companies' prices fall. And the other one is gilts and government bonds of any kind, US treasuries, have done brilliantly. So the yield on those have fallen to levels not seen in over 100 years. And that's because, again, in a low interest rate world, a bond is effectively like a loan that's being repaid. And so with a steady interest payment, the coupon that you get becomes more attractive if the interest rates are falling everywhere else. You imagine you can't get anything in the bank. Bonds are an attractive proposition because their income will stay the same. It's fixed, hence the term fixed income, which people use for describing bonds. But interestingly, you may have seen you've got some bond funds. You might be looking at your portfolio and going, wow, hold on, why is my bond fund down over this period? It might not be down much, but we're getting to the period now where the quality of the debt is important. So if you have a company, because companies can issue bonds, governments can issue bonds, but it's all about the credibility, the credit worthiness of the company or country that issues that loan. And so in a recession, you start getting to the point where you're worrying about companies potentially going bust. So therefore, bond funds can invest in corporate bonds, so bonds issued by companies rather than governments. They won't have done as well and may have lost a bit of money, whereas something investing in gilts and treasuries will have made a positive return. So it's interesting just seeing these dynamics, why things are going on. It doesn't mean the world's imploding because your bond fund hasn't made money, but it's protecting your capital more so than if you'd invested in, say, equities. You'll see currency markets are moving around the place. So the euro's been rallying. You'll notice that your European funds have been tanking, but then recently you've got a little bit of a kicker because the euro's been strengthening. And it's because of this dynamic between central banks. The Fed cut rates, the ECB, the European Central Bank hasn't yet, the Bank of England hasn't yet. So you get this disparity where if one's cutting interest rates, that will mean their currency falls against somebody else's that isn't. It's a bit like having two bank accounts. If a bank had a bank account that was suddenly cut the interest rate on it, people would take their money out and put it in one bank account that are still paying some interest elsewhere.
And then eventually it's likely that they'll make a change and it'll all sort of even out.
Yeah, so what you're going to see probably is swings in currency markets because the pound fell to about 127 against the dollar this week, but it's now, as I talk, back above $1.30. So we're getting these swings and it's difficult you shouldn't try and predict it, but the message is that at the moment, markets are incredibly volatile and reading too much into any given day's market moves can make you make the wrong decision, particularly when we see the fear index, the VIX, up above like 30, 31. That's really high. We're up towards 40 now. So you're going to get these wild swings. It's almost getting to the point where we saw 3% swings almost every day now, up or down. So don't focus on your portfolio moves too much, but at least you can understand it. I just hope that people listen to this section. If they look at their portfolio, their pension, they're sitting there thinking, blimey, my portfolio's down 5%, 10%, then think about how much equity exposure you have. If you have about 60% equity exposure and the market's down, 10%, you should be down probably around about 6%. But that's the importance of diversification. It brings that home because not everything will go down at the same time and when you have a portfolio that's diversified. But when the market really does sell off, there starts to become a slightly more positive correlation. So you start getting bonds falling at the same time as equity. So don't be surprised at that. That is just what happens in this environment. So hopefully I'll put some people's minds at ease. And going forward, I don't know what's going to happen with markets. But one thing I've been talking about this week to 80/20 investor members is what happens when central banks start cutting interest rates. We haven't really got into it yet in this sell-off because I think there could be a collective movement of more people cutting rates, not just the Fed. And I would just say to people that if the market isn't bottoming and it keeps falling, then what will happen? Where will it stop? It'll probably, if you look at towards China, people might not realise, but the Chinese equity market hit a 2-year high, and the reason it did is probably down to the fact they've chucked the kitchen sink at it this year. And so it's rebounded from the sell-off due to the coronavirus. And whether that's complacency, I don't know. We'll have to wait and see. But if we start seeing central banks going bonkers, cutting rates, this will be the first of many. I'm convinced of it. I think there'll be a number of cuts this year. I mean, think of the financial crisis. The last time we had an emergency interest rate cut by the Fed was back in 2008, but they occurred in 2007 as well. But just because they did that, it didn't stop the market falling. So be prepared. We could see the market fall more. But at the same time, if they throw the kitchen sink at it, then we might get a rebound. But this is what makes investing interesting. You're never going to get it right. You're never going to know which way the market goes. It's just about risk management, diversifying, and not reacting or overreacting.
Okay, moving on to the last piece. Buy now, pay later. It's becoming more popular. I'm seeing it lots when I'm going on to various sites. Amazon are offering it now. What is it and why is it so popular?
Well, the whole buy now, pay later, I mean, I think it can pass a lot of people by because I'm not prevalent at shopping online. I just don't. That's because I don't shop generally. It's not because I go offline. It's just because I don't particularly shop online. And about 6 million people are using or have used buy now, pay later options. And it's particularly popular among young people. So people between the age of 18 and 34, 70% of them have used it in some form. And the way it works is that there are fintechs out there, and to name the main players, it's Klarna, ClearPay and Lay-Buy are 3 of them, and they supposedly offer this frictionless credit but on smaller purchases, because there's been the idea of buying something and paying for it down the road has existed before. We had catalogues who used to do it for years, but this is on much smaller amounts, as little as £10. And what happens is you go and buy something through a whole host of retailers that you know, and one of these firms will probably be there on the checkout and offering the option to buy now, pay later. And what tends to happen, you can either delay payment for 14 to 30 days, or you can split it over installments. You end up paying it over a period of time. But it normally is something like you'll pay 4 installments over, again, like maybe 4 weeks or something like that. It depends on the time frame, depends on the company. If you do the latter part, they do a hard credit check on you. But the whole thing that is the attraction to people is that it's fee-free and it's interest-free. So they sit there and think, well, why wouldn't I do it? And that's the danger. And it's the only thing I want the message to be on this piece. There's nothing wrong with using different forms of payment, but it shouldn't be the reason why you make the purchase. So how do the companies make money? It's through transaction fees, and they often get a percentage of the amount that you buy. So they earn money basically from the retailer. Yeah. But this is where it shows you the psychology behind it, because they've shown that people spend 20 to 30% more if they use the buy now, pay later route rather than just paying for it up front. And of course, for those buy now, pay later companies, that's the whole point. Because if they're getting a percentage possibly of the item you're purchasing, the amount you spend, it's in their interest to make you pay more and make it easier. And so the way it works once you've bought it, you don't repay by direct debit like you do with a credit card. It's one of those continuous payment authorities, which is not in itself a bad thing. It's just how companies use them is where the problems arise. So in this instance, it enables the lenders to have more control over actually getting the payment back. I mean, in the end of the day, you're meant to be paying back in installments. If you pay by credit card, you have a bit more control about what you pay and when. And the other thing is that with these lenders, you still have to pay late payment charges as well. And if you don't pay the agreed installments, then it can hit your credit record, because they can therefore report it to the credit rating agencies. And so for young people who just buying things because they want them now and they can't afford it, then it could, if they don't pay it, impact their ability to get a credit card to get a mortgage further down the line, when obviously you were talking about years down the line it could impact them. So that is the issue with it. It's not in itself, like I said, a terrible thing if it's used responsibly. But the one thing I would say to anybody is, if the reason that you're buying something is because of the means of payment, buy now, pay later, then you have to bring into question whether it's the right thing to do. So if that wasn't available to you when you're at the checkout, would you have bought the item? If the answer is no, then you probably shouldn't buy it. And there have been a rising number of people who've got themselves into difficulty with this kind of payment offering, and like I say, impacting their credit reports, where they have actually bought things they couldn't really afford and they should have either saved up or not bought the item at all. So the other thing to bear in mind is there's the regulation around this industry is in its infancy. Now, say lay-by, for example, now they are not regulated according to the BBC when I was reading around the topic, because they don't actually charge you interest, because what they're doing is they're giving you some money and they're making money from the retailer and they're not actually charging you interest. So in that regard, it means that they aren't having to be regulated in the same way. So the FCA has got involved in improving the way some of these companies have operated and the way they made money, etc., which can only be a good thing. In any maturing tech-led industry, it's important that the FCA is involved. But I suppose the other message is, what are the alternatives to this kind of thing? Okay, saving up. But the other one is, I suppose, is 0% purchase credit cards if you do need to make the purchase, but because at least then you can manage the way it's paid back.
And you can budget better as well, right? Because you can set up a direct debit and you'll know you'll be paying hopefully more than the minimum. You'll set up how much you need to pay and pay it off before there's any interest charged. My worry on these continuous payment authorities, if you keep purchasing things, it's hard to keep track of those because you can't, in the budgeting apps, there's nothing to budget for.
Do you know what, Andy?
It's almost hidden.
It's such a good point, because one of the big takeaways when I was looking into, I was researching people who had problems with it and the stuff that was going on around this industry. And the stories that I read were from people who said exactly what you've just pointed out, that it became difficult to manage. It
just
became
keep track of everything.
Just to keep in
know
track.
when it's coming out and how much.
Exactly. It's not that the companies are trying to mislead people. It's just because from a management perspective, it becomes quite difficult. If you've purchased things, you're paying late, and like Andy said, you're not seeing necessarily the payments on your account with a direct debit or whatever it is, it makes it more difficult to manage. And if people are already thinking about buy now, paying later, then there is a suggestion that they probably are struggling with their finances potentially anyway. So I'm not a massive fan of it. I think it's got uses, but just use it responsibly like anything when it comes to credit.
Okay, so if you want to get in touch with Damien, you can do so. It's Damien@moneytothemasses.com. Twitter, it's @moneytothemasses with number 2. Don't forget, we're on Instagram, Facebook, and also YouTube as well. Also, we have the Money to the Masses community group. Go to facebook.com/groups/Money to the Masses, and you can check us out there. And we'll be popping the FT article in there on Sunday, so you can have a read through that and see what that was all about. Are we done?
We're done. And the only thing to say is, don't forget to leave a review of the podcast, wherever you listen to your podcast, but particularly iTunes, because I look on that one.
Yeah, right. Until next time.
Until next time.